We are live. How you doing, friends? Ernie here, and this is the 0 Days to Expiration podcast. And we're up to episode number 74. Whoa. We had a little lag there once we hit about 65 or so, and we were doing about 3 times a week, and then the New Year's came, vacation time came, and things slowed down. I got lazy, but now we're back to 3 days a week. Every Monday, Wednesday, and Friday, reporting on the last day of expiration trading for that week, for that day. And today was a good one. Today was a very good day. We actually had 2 trades. Well, actually, officially just 1 trade. We were fancying around with another strategy, and that worked out. And I don't believe everybody took that, but our second trade is certainly a winner. As a matter of fact, we are currently at what we would call in position for a pin. Very rarely does that happen. A pin trade is where you set a target and you hit it, you pin it, pin the tail on the donkey. So there's still a question on whether or not that will hold right through the day, although it's been sitting here for quite some time. So long that I actually dozed off, so that's why I'm a little bit late here to the podcast. So today I wanted to talk about the different types of strategies that we employ. And maybe I'll start with just what we do here and what we did today. So 0 DTE. First of all, what is 0 DTE? 0 DTE, the last day of expiration. Of course, talking about trading options on the S&P. Now, there are 3 different ways that you can trade options on the S&P. There's the SPY, there's the futures, the ES, the E-mini, and then there's the index, the SPX. They all have their pluses and minuses. We like the futures for the ability to trade around the clock, and the SPX for its size and liquidity. The SPY, probably don't trade that as much. It's a smaller contract, so it's not too bad, but has its issues. Now, the S&P, along with the NASDAQ, are one of the few indexes that are out there that has multiple days for expiration within a week. Most options, all options, have monthly expirations. And as of about 12 or 13 years ago, or 15 years ago, we started with weekly options, where options would expire of each week. And I remember Apple was one of the very first weekly options assets. And that was good, because now you can employ a lot of the same kind of strategies that you had for monthly, but now you had 4 opportunities a week. The S&P and the NASDAQ now have 3 per week, Monday, Wednesday, and Friday. And in fact, the SPX, just recently, I believe the CBOE has okayed 5 option expirations per week. So every single day, the SPX, you'll be able to have a separate contract that expires every day of the week. Now, it's not clear whether or not all brokers are going to pick that up, if you'll actually be able to do it. So, for instance, the SPX also was cleared for doing trading around the clock. Most trading platforms still only allow you to access it during normal cash market hours. If it went around the clock, then there would be a very good reason to just trade the SPX over the futures. But right now the futures have that advantage. But trading 5 times a week, wow. I'm trading 3 times a week because that gives you this natural cadence and you have time off in between trades. When you're trading every day of the week, it almost seems like you're under this sort of pressure to perform. 5 days a week, that's going to be very interesting. Now, what is so significant about trading the last day of expiration if you're trading options? Well, if you know anything about options, you know that premium decays on an options contract. It starts out way up here, and then right down to the very last second of expiration, it decays until the premium, the time premium, or the volatility-based premium disappears. And then you're just left with the intrinsic value, if there is any intrinsic value in that options contract. And as you get closer to that last second of expiration, the rate at which premium decays increases exponentially. So that's really important for an options trader, because that can either work for you or it can work against you. If you are long an option and you're banking on the value of that option going up, or if you are banking on more than just the intrinsic value and the time value, you're working against time as that time premium is decaying away from you. So you're really banking on that intrinsic value moving in a positive direction. So that's an issue with trading long. But as a short seller of an option, it's the exact opposite, because as that premium is decaying and moving away from the buyer of an option, it is actually the benefit of being the seller or writer of an option, where that premium is going towards them or into their account. So that gives you a distinct advantage. And if you can take or create strategies that would not only put you in the right position in terms of where price is, but also position in such a way that you're collecting that premium, you're going to benefit. So it's like betting that I'm going to be here, and then while I'm there, as I'm going towards that destination, I've got the wind at my back, and it's cool. I'm being paid for actually taking my time to get to where I want to go. So that's a huge edge. Another real big edge in that premium collection scenario is that the rate at which or the amount of premium that is coming into that contract is generally overstated. So in other words, volatility is the primary ingredient to the premium that is in an options contract. And the pricing of an option is routinely overstated depending on market conditions. So what that really means is that as the seller of that option, you are selling something that is price inflated. You're selling something that's overpriced. Imagine if you were a store owner and you were able to mark up all of your products 5, 10, 15%, and people would gladly come in and pay you that extra money for them. That's what it is selling premium. So you got these things going for you. Now the hard part is being at the right place at the right time to collect that premium, because the market obviously doesn't care what you think or where you think price is going to go. It's going to do what it wants to do. So we have to come up with strategies that will allow us to collect that premium as we get closer and closer to that expiration. Now, for instance, today, we chose a contract where the maximum collection would happen at a point right about where we're at right now. And we've got about, an hour left in the market. So there's a fair amount of, believe it or not, even with just an hour, a lot of premium left in our options contract. Now, we have collected some of it, but not all of it. What are the chances that we're going to be able to stay right here, right to the end of the day, and price is not going to move? Probably pretty small. So we have to make a decision, do we stay here and sweat it out and see if we can actually collect that premium, or do we take what we have and be happy with it and then move on? Now, there are some reasons why we might think that price will stay here, right? We don't just pick levels or prices arbitrarily. There is a deal of analysis that you would do to try to determine whether or not that's a level that price might gravitate towards. And what we use is we use volume profile. With volume profile, we can determine the areas that are more likely to, where price is more likely to gravitate towards, and the areas where it is most likely to find support, resistance, or be rejected from. And so we use that information to help us place trades in such a way that we believe there's a higher degree of probability that price will gravitate towards or away from. And so that's what we did today. Of course, there's a lot of ways to make money in a trading day on the last day of expiration. Having that premium characteristic is really important because that gives us an edge. There's an inherent edge in that. Being able to do analysis that would get you in the position where you think price will be also is an edge. There are other factors, though, that come into this. There are outside factors as a trader, that there are catalysts that are out in the market that are constantly pushing the market in different ways. And so we use that as well. Ultimately, you want to, so in other words, there are economic reports that come out in the morning, usually around 8:30, 9 o'clock, 10 o'clock. And they will provide some energy to the market. That energy will give us some kind of bias of where we think price is going to go. So we have to have an understanding of those catalysts and what the relative energy that they may put into the market. What is the overall characteristic of the market? What is the structure of that market where we do our analysis using volume profile? And what type of strategies can we employ that will put all of that together to put us in the right place to give us the maximum opportunity to collect premium? That is one way that we can make money, and that's the premium collection. Of course, we can also make it with price direction. The premium collection is a more forgiving way of putting strategies together because you've got time on your side. The directional methodology and strategies that use direction is opportunistic if you're good at being able to tell where price is going to be, or at least where price might go or go through. So like today, we did two different strategies. In the beginning of the day, we felt that there was going to be a relatively large amount of volatility in price, and it's going to move. Overnight, we had a lot of big companies that reported this morning, and they provided a catalyst or energy into the market, causing the market to come down. And so before the open, we thought price might come down sharply. So we have to come up with a strategy that would allow us to capture that relative move. But all of these strategies, whatever we put on, like this morning, putting on a back ratio to try to take advantage of a sharp movement, or this afternoon, putting on a butterfly to capture the premium collection. All of those are different strategies for modeling different aspects of what you think is going to happen in the market. What is the timing? What is the rate of decay? What is the current volatility? It is a complex equation. So you try to create things that will cover a wide range of possibilities. So when you're talking strategies, it's not like you can just come up with one blanket strategy and then just apply it the same way every time. And that was one of the issues that I found when I first started doing zero DTE. That was the go-to thing. People had decided that this was all too complex, that the best way to approach this is to, first of all, employ some sort of premium collection strategy, like a butterfly or an iron condor or something like that. But because of the complexities of how am I going to determine where price is going to be at a certain time, that was too complex. So what they would do is choose strategies that took that problem away, and choose strategies that were very high probability. So choosing a very wide range of prices that price might fall inside. The problem with that is that when you do that, you do two things. One is that because you're choosing a very high probabilistic trade, the amount of premium or opportunity that you're going to collect naturally is inversely proportional to that probability. So in other words, you put on huge ranges of prices that would put you in profit, you can only expect then to capture a very small amount of profit. And then the antithesis to that is that if you do not sit inside of that very wide range and you move and price moves against you and outside of that range, the risk that you take is tremendous. So a general risk to reward scenario might be something like 10 times risk for 1 times reward. To complicate that, as you get closer and closer to that very last minute of expiration, the gamma risk that you encounter, or the profit curve, starts becoming very concave. And because of that shape, is producing what we would call gamma risk. That's the rate of change in delta, or the rate in change. So in other words, the more price moved, the faster the value of your option contract would move as well. So coming down to that very last moment starts becoming even more tenuous, trying to figure out whether or not I'm going to make some money. However, that's what most traders have figured out is their best opportunity. Put a very high probabilistic strategy on, and then just go for a small amount of profit. And because of that gamma risk, even taking an even smaller amount of the available premium that there is there to collect. So a typical good day for another zero DTE trader would be to put on, say, $1,000, going after a potential of $100. And then once you reached half of that potential, quickly get out of that trade and consider yourself have accomplished a good day's work. And if you could get that full 10%, that's like a home run. Now that's great until you get to those days where price gets away from you and you exhibit that 10 times loss. And so in order to guard against that 10 times loss, they will go outside of that whole paradigm of this very wide range of potential profit making, and they will set stops in your option and essentially cut that range down so that if you start getting close to the risk side of your strategy, they will only allow you to get so far. And that's because of the gamma risk. The profit that you're making as you move away from that centered, pinned, ideal trade, your actual trade is before expiration is in the red. And sometimes it can get so far in the red, even though you're still inside a profitable area at expiration, that time before expiration is saying that the odds say that there's a chance that you could go well outside that and experience, say, 10 times loss. So in order to avoid that, they will accept only up to a 3 times loss. So essentially, they are taking the high probability trade and then cutting that down to a relatively low probability trade and still going for a very tiny bit of profit. So that's what everybody else is doing. What we do is something kind of the inversion of all that. We don't look at the destination of price and say that we don't know where price is actually going to be, so let's just cast a wide net and only use a strategy that is meant to be used for market neutral situations. In other words, you put on one of these wide ranged probability trades, you're putting it on mostly because you're expecting price to remain within a certain area, but you don't really know. So they're applying a strategy that is not conducive with what the market is normally doing. Normally, the market isn't neutral. As a matter of fact, the market is neutral a very small amount of the time. Market neutral trades probably are good for maybe 10% of the trades that are out there, maybe 20%. Markets do consolidate, but even within the consolidation, they consolidate it could be a fairly wide range. So putting on a very wide-ranging, say, an iron condor, still you're taking very large risks to go after a very small amount of profit. So these market neutral strategies, or the application of them, is not optimal. And it's not realistic. You're not using a strategy that is coincident or appropriate for what the market is actually doing. We've flipped that all on its head. And instead of taking that incredible risk up front, what we decide to do is we want to use premium collection strategies like a condor or a butterfly, because they are definitely the best ways to collect premium and take advantage of that edge that you're provided. But we treat them as directional strategies and put them out of the money, away from us. Now, we don't know where price is going to be, but maybe we can at least tell in what direction it might be going. Right now is a really good example of something like that. Our analysis told us that price would be at a certain point. In this case, I'm going to give real numbers at 45.10 on the S&P today. That would have been the most logical place for price to go according to a volumetric analysis, that most of the volume has settled on that point. So we put a strategy there. And of course, price was well below that to start the day. And we thought that price would gravitate towards there, and it did. And it gravitated towards there and then consolidated around there. And that gave us a time price opportunity to collect profit, which we did. Now, we didn't collect the maximum of that profit. See, right now we have about 45 minutes left in the market. Now it's moved out of that area. It's gone actually higher. And so as it moves away from there, if we had stayed in the trade, we're losing money. But our best opportunity was to put a premium collection device there and make it wide enough that we can capture enough potential range of prices and collect the maximum amount of profit. But we want to do it in such a way that if we were wrong, it's not going to hurt us. So by taking these strategies like a butterfly or a condor and moving them way out of the money, that reduces our initial risk and our max risk, but increases the potential for making profit. The thing is that while it's important to consider that what our max risk might be, that's not so important to be your goal. Your goal should be to just have some kind of range of prices that would work for you. And if you can get the risk down low enough compared to the amount of money or profit that you can collect, you can do that in such a way that you can have the same kind of probability of profit that the other fellows and folks are taking with these market neutral strategies, but put them in a directional strategy and change the whole risk to reward paradigm around completely. So now, instead of using $1,000 to go after $100, we can use $100 to go after potentially $1,000. Now, $1,000 would be our ultimate if we pin the trade. But we recognize that's only about a 10 or 15% probability. However, there's a spectrum of prices in between there where we can still make 50%, 100%, 200%, 500% of our initial risk. Whereas the other strategies, they never have that opportunity. They're always putting up $1,000 to make what? Maximum 10%? They're happy with 5%. They might make 2%. They might lose 1,000%. At its face, that whole paradigm, that strategy selection, idea, and treating things that way is just wrong-headed. It produces incredible anxiety. It's just not a comfortable way to trade, and you don't have a great opportunistic outcome. By flipping that on its side and taking small risks, going after potentially large profits, yeah, sure, you're not going to make that huge profit every once in a while. That's a high-quality problem. Most of the time, we're going to be making 50 or 100, and on average, 150 to 250% of the risk that we take. Now think of that. With about the same win rate, let's say that there could be anywhere from 60 to 90% depending on the markets. Let's say it averages 70%. With about the same win rate as these other strategies, instead of risking 1,000 to make 100, we're risking 100 to make 1,000. And where they are capped at about 10% of their total risk, we have no such cap. Our cap is 1,000%, sometimes as much as 2,000%. Additionally, because our initial risk is so small, we don't experience the same kind of anxiety level that the other trader does, where they're in a position where if their trade goes wrong, they either have to stop out or potentially lose all the profits that they've made for the last 6, 7, 8 sessions. If you stick to just a small risk per trade and you're averaging 2 to 3 times that on every trade, with the possibility of making 10 times that, it should become very apparent to some that this type of asymmetry is much more conducive to trading the way the market is presented to you, where it's unknowable. And because it's unknowable, you place trades in such a way that, yes, you'll be rewarded for pinning that trade, but you'll also be rewarded for just being in the ballpark. So that's the primary strategic difference between the way we do it at 0-DTE and everybody else. For some situations, we'll use strategies that will take advantage of just pure price movement. And if we miss, we want to miss in such a way that it's not going to hurt us later on. So for instance, a naked long option has an inherent lot of risk that decreases as you put it further and further out of the money, but then your probability goes down. But if you're very close to the money, then your risk is very high. However, you could put on a trade that would decrease that risk somewhat. One way to do it is to do a simple vertical, but another is to use something like a ratio spread, a back ratio spread, where you can take advantage of a catalytic moment in the market that sends price in one direction, and you can profit dramatically. And if it doesn't go that way, you could set it up so that the other side, the bad side of the trade, ends up being a credit. So that's what we did this morning. And this is an experimental trade for us, but it was an initial trade. Here we can put on a ratio spread to capture a volatile market, and if it ends up not being that way, at least the second best option is at least collect a little credit. And now that we go later on in the day, now that we see where price is going to go, we can use our analysis to put on one of these premium collection tools and put it far enough out of the money so that we can control our risk to reward. In this case, it was about 1 to 9. And then because we're already collecting credit on the back end of the ratio spread, that discounts the price that we're paying or the risk that we're taking on this out-of-the-money butterfly. Now we have a butterfly that cost us practically nothing. And now we're going after 10 times what the risk that we're taking on, or even a greater asymmetric trade. So we're using our strategies in such a way that asymmetry is the order of the day. Take small risks, for a very large potential gain and take anything in between. And so that's exactly what happened today. So today was a very successful day. And that is the strategic difference between what we're doing here. It's more nuanced. We're not applying just one premium collection strategy and then making it so wide that it covers all our bases. What we do is we take an intelligent look at where price might be and then placing asymmetric trades in places where we think they will be, and then taking advantage of that and not suffering when we're wrong. Hopefully that makes sense. And that is the difference between what Zero-DTE does and all the other services. I think you'd like it. If you'd like to try it out, go to zero-dte.com/try, and you can try out the service for 4 weeks. Another thing that differentiates what we do here is that this service really isn't all about our alerts. This service is about teaching these various strategies on how to trade with asymmetric setups and make them your own. So it's an educational service that uses the alerts as a demonstration of the strategy. And we've become very successful at that. We've only been in operation for just about 10 months now, have about 500 customers, and we're growing very fast. So if you'd like to join us and trade the asymmetric way, then go to zero-dte.com/try. All right, that's about all I have to say. If you have any questions, please put them in the comments below, and I read all the comments and I'll answer them to the best of my ability. But your best bet is give the trial out a try. All right, and it looks like we are not going to pin the trade today, but we made money coming into the trade. We made money going out of the trade. And now we've got a great weekend to look forward to. That's it. Peace. See you next Zero-DTE opportunity. That will be Monday. Take care. Okay, now I must find the off button. It's way up there.